first talk about the equity types of investments. We're going to talk about stocks and shares. We always talk about stocks as one of the most common investment, but what does that mean when you invest in it? Well, it means you're buying and selling ownership in companies. For example, Apple at the moment has about 16 million shares. If you buy one share of Apple, you would own 1/16 millionth of Apples. How cool, a tech company and spending less than £200, you own some ownership over this cool company. And as they grow, you make some money. So why does companies sell share? If Tesla, Microsoft, they all performing so well, why do they need that? And more money means more capital to grow their market, right? They all need money, regardless how profitable they are. They can use this to employ more people for better marketing and sales team. They can also use this for R&D products. So you see the new iPhone or the new Tesla product, they probably using your investors' money to build these R&D projects. Also to pay off debt. There are two ways of making return in stocks and shares. First is through capital gain. This is the most common way of what we've seen on the news of how people make money. The second one is also less talked about, but also very, very attractive for long-term investors, is through dividends. Think about stock as a tree, how company perform as a tree. Capital gain means a company grow from a smaller tree from a seed all the way to a tree. So when the company grow, your stock prices go up. So you have a lot of small to medium company wanting to grow to larger company, etc. And when that happens, you make money in your stock prices because it went up. On the other hand, dividend is for companies that are more established, old companies that has been on the market for years and they have a decent fruit to enjoy. So the profit they make every year, they cut a part of it and give it back to you as form of dividends. We're going to look at some examples. We're going to first talk about the capital gain sort of companies. So when the stock prices go up, you sell your stock. What does that mean? Tesla is a very famous automotive company. In the past 5 years, if you invest 5 years ago, your capital gain will be 1,245. So any £1 if you invest now will be worth of 1,245. However, because Tesla is a growth company, right? So they don't offer any dividends. When you invest in companies like Tesla, you're looking for the capital gain, looking for the company to perform and the stock prices to go up. How is stock prices affected? Well, there are many complex reasons. That's why we have professional traders monitoring the market, the company's performance too. But it could be reasons like overall economy. For example, during COVID, a lot of stocks went down. Could be companies' performance, how well they perform, are they generating profit. It could also be investors' perception and also market news. Sometimes you see the CEO of this company have the scandal comes out and then the next day you see the stock prices went down. So this is some of the reasons, but they are very, very complex. And if you wanted to back for its stock capital gain, then you wanted to stay very close to the market and monitor. On the other hand, through dividend is a fixed income that's coming back to you. Usually, again, it's a company who are established. So some example would be like P&G, AT&T, Coca-Cola. They have a steady profit margin over the year and they know how much profit they can generate because of the track record they've had in the past. So here's an example of P&G. Is an American consumer brand, including like Otzi, Olay, Pampers, all these very well-known things we see in the supermarket. In the past 5 years, if you invest 5 years ago, you will receive an annual dividend of 2.5 of your investment. On top of it, you also get the capital gain of 91%. So to further understand how looking at the growth potential and also dividend, it's important to understand these two concepts. One is growth stocks versus blue chip stocks. So growth stock is usually company that offer growth potential, right? So you're looking for the capital gain. They usually take your investment and also the profit they made from the product for market expansion. While on the other hand, blue chip stock, they are established, has been in the market for a long time. They have a reliable performance and often they pay dividend. Here are some examples. Growth stock like Amazon, Netflix, Shopify, Tesla. These companies, when you invest, looking for the growth potential instead of giving out dividend. On the other hand, you have blue chip stocks that give out dividend like Apple, P&G, and Coca-Cola. If we put these two charts side by side, what you can see is, the growth stock is obviously the growth is more bumpy. You have ups and down. It fluctuates over time, and you need to kind of take some betting. On the other hand, when you're looking at these blue chip stocks, they are more steady performance, and they have a history of giving out dividend. Are there stocks that provide both, that I can have the capital gain and also dividend? Well, if you invest in blue chip stocks, you can enjoy both, but the capital gain will not be as exponential as those growth stocks. Tesla is like 1,245. That's something that you would not get from blue chip stocks. But if you're looking for a fixed return while seeking long-term asset growth, you still see from P&G over the 5 years, 91%. It's not bad, right? So it is still attractive for long-term investors. To further understand how the blue chip stock and also growth stock works, when you are looking at the category of stocks, that could give you a better idea as well. So eventually, a goal for every public company, so all the company you see in the stock market, the goal is to grow bigger in its valuation. So you have the small cap and medium cap. These are the companies that have high growth potential because from small cap, they want to go to medium cap. From medium cap, they want to go to large cap. The market capitalization is the company's net worth. So when you are in the large cap and you have been there for years, that's when you are thinking about, whether you want to give out back your profit to your investors if you have so many years of generating profit and it's been reliable. So here are the pros and cons for investing in stock and shares. The pros are, your investment's main growth driver. When the stock goes up, you can see the money, your investment money goes up, right? Also, it's really cool to become a stakeholders in a company, invest in company that are generally doing good to the world, that you generally believe in the company. You own ownership part of that company. So it's a very cool thing. The cons are, risk of loss. One single company's performance is quite a risky investment, right? And when the market goes down, then obviously you feel very emotional and you could feel stress as well. And obviously, when you're looking for these growth stock, it requires a lot of time and research, and you want to stay very close to the market to monitor it. Here's the homework. I would like you to download a stock watch list on your phone. I want you to research a selection of small cap, mid cap, and large cap stocks. Add them to your stock watch list. And if you are a fan of blue chip stocks, I would like you to have a look at Warren Buffett's top 5 stocks holding.